Hi, welcome to the channel. Today, we're diving into a topic that's probably already affecting you, whether you've noticed it or not. Inflation. Prices are rising everywhere, from the groceries you buy to the rent you pay. Even little things, like your favorite cup of coffee, suddenly feel more expensive. But what's really happening here? Inflation isn't just about prices going up. It's about the value of your money going down. That's why it's so important to understand what inflation is, and more importantly, what you can do to protect yourself. Let's break it down. Inflation, in simple terms, is the rate at which prices for goods and services increase over time. Think about it this way. If you could buy 10 items with $100 last year and inflation rises by 5%, you'll only be able to afford 9.5 of those items today. Your money didn't disappear, but it now buys less than it used to. And this isn't just a small problem. Over time, the cumulative effect of inflation can significantly erode your purchasing power. Now you might be wondering, why does inflation happen? One common reason is what economists call demand pull inflation. Imagine a scenario where a lot of people want to buy the same product, but there isn't enough supply to go around. Companies, knowing the demand is high, increase prices. Another reason is cost push inflation, which happens when the cost of producing goods rises. For example, if the price of raw materials like oil or steel goes up, manufacturers pass those costs on to consumers. And then there's monetary inflation, which occurs when central banks print more money or keep interest rates low for extended periods. More money in circulation often means higher prices because there's more cash chasing the same amount of goods. But let's focus on what this means for you. Inflation doesn't just affect what you spend, it also affects what you save. If you have your money sitting in a savings account that earns, let's say, 1% interest per year, and inflation is running at 3%, you're actually losing 2% of your purchasing power annually. It's like trying to climb up a down escalator. No matter how hard you work, you're still losing ground. This is why so many people feel like they're falling behind financially, even if they're earning more than they were a few years ago. Inflation isn't just something that happens in the background. It directly impacts your day-to-day life and your long-term financial goals. That's why understanding it isn't just for economists or financial experts. It's something everyone needs to think about. But here's the good news. While inflation might be unavoidable, it's not unbeatable. The key is to take action now rather than later. Too many people make the mistake of thinking that inflation will pass or that their current saving strategy is good enough to keep up. Unfortunately, that's rarely the case. If you want to stay ahead, you need to be proactive. The first step is recognizing that cash alone isn't enough. While it's important to have an emergency fund, keeping all your savings in cash means you're guaranteeing a loss of purchasing power over time. So what's the alternative? The answer lies in putting your money to work. Investing in assets that grow in value, like stocks, real estate, or inflation-protected bonds, is one of the best ways to not just protect your wealth, but also grow it. In the next section, we'll explore some of these options in detail. We'll talk about how to make your money work for you, even when inflation is high. But for now, here's the takeaway. Inflation is a challenge, but it's also an opportunity. By understanding how it works and taking the right steps, you can turn inflation into a tool for building your financial future, rather than letting it erode your savings. Now that we've laid the groundwork and understand what inflation is and how it impacts your money, let's talk about what you can do to fight back. The good news is that you don't need to be a financial expert to protect yourself from inflation. You just need to take a few smart steps to make your money work harder. And the key to doing that is investing. Let's start with the stock market. For many people, the idea of investing in stocks sounds risky or even overwhelming. But here's the truth. Over the long term, stocks are one of the best tools for beating inflation. Think about it this way. Companies don't just sit still while prices rise. They adjust. Businesses raise their prices to match rising costs. And as a shareholder, you benefit when their revenues and profits grow. Over time, this means that your investment grows too, helping you stay ahead of inflation. If you're new to investing, the stock market might sound complicated, but it doesn't have to be. A simple way to start is by looking at index funds. These funds track the performance of a group of stocks, like the S&P 500, which includes some of the largest and most successful companies in the world. What makes index funds so appealing is that they're diversified. Instead of putting all your eggs in one basket, you're spreading your investment across hundreds of companies. This reduces your risk and makes it easier to weather the ups and downs of the market. But stocks aren't the only way to protect your money from inflation. Another excellent option is real estate. Historically, property values have tended to rise alongside inflation, making real estate a reliable hedge. And there's more to it than just owning a home. If you own rental property, for example, you can adjust rents over time, keep up with inflation, creating a steady income stream that grows as prices rise. What if buying property isn't in your budget right now? That's okay. You can still benefit from the real estate market through something called real estate investment trusts, or REITs. These are like mutual funds, but for real estate. When you invest in a REIT, you're essentially pooling your money with other investors to buy and manage income-generating properties, like apartment buildings, shopping malls, or office spaces. It's a great way to gain exposure to real estate without the hassle of owning and maintaining property yourself. Another powerful tool in your inflation-fighting arsenal is bonds, specifically inflation-protected bonds. These bonds are designed to keep up with inflation, so their value adjusts as prices rise. While bonds might not offer the same high returns as stocks or real estate, they provide stability, making them an excellent addition to a balanced portfolio. Think of them as the anchor that keeps your investment plan steady, even in uncertain times. And we can't forget about commodities. Things like gold, oil, and agricultural products tend to hold their value or even increase during inflationary periods. While commodities aren't for everyone, they can play a role in diversifying your investments. Even small exposure to commodities can help balance out your portfolio and provide additional protection against inflation. So, how do you decide which of these options is right for you? The first step is to think about your goals and your timeline. Are you saving for a short-term need, like a down payment on a house, or are you focused on long-term growth, like building a retirement fund? Your answers will help guide your decisions. For short-term goals, safer options like bonds or high-yield savings accounts might be the way to go. For long-term growth, you can afford to take on more risk with stocks or real estate. But no matter what you choose, the most important thing is to take action. Doing nothing isn't an option because inflation won't wait. Every day you delay is another day your money loses value. Start small if you have to, but start now. Even small, consistent investments can add up over time, especially when you take advantage of compound growth. The bottom line is this: inflation is a challenge, but it's also an opportunity. By putting your money into assets that grow in value, you're not just protecting your savings, you're setting yourself up for financial success. In the next section, we'll talk about how to create a personalized investment strategy that fits your unique situation and helps you stay ahead of inflation for the long haul. Now that we've explored the tools you can use to fight inflation, let's talk about how to bring it all together into a strategy that works for you. The truth is, there's no one-size-fits-all approach to protecting your money from inflation. It depends on your financial goals, your timeline, and your comfort level with risk. But there are a few principles that can help anyone build a strong foundation. First, let's start with diversification. This is one of the most important concepts in investing. Simply put, diversification means not putting all your eggs in one basket. By spreading your money across different asset classes, stocks, bonds, real estate, and even commodities, you reduce the impact of any one investment losing value. For example, if the stock market has a bad year, the real estate portion of your portfolio might still perform well, helping to balance things out. Diversification doesn't eliminate risk, but it makes your portfolio more resilient in the face of uncertainty. Another key principle is consistency. Many people try to time the market, waiting for the perfect moment to invest. But the truth is, no one can predict the market with complete accuracy. Instead, focus on staying in the market and investing regularly. This strategy, often called dollar cost averaging, helps you avoid the stress of trying to buy at the exact right time. By contributing a fixed amount on a regular schedule, you buy more when prices are low and less when they're high, which averages out your costs over time. It's also important to keep your goals in mind. If you're saving for something long-term, like retirement, you can afford to take on more risk. Over decades, the growth potential of stocks and real estate can significantly outpace inflation. But if you're saving for a short-term goal, like a vacation or a new car, you'll want to prioritize safety and liquidity. In this case, options like bonds or high-yield savings accounts might be a better fit.
Finally, don't forget to regularly review and adjust your strategy. Life changes, and so do market conditions. Checking in on your portfolio at least once a year ensures that you're still on track to meet your goals. If inflation is rising faster than expected, you might need to shift more of your money into assets that grow in value. And as you get closer to reaching a specific goal, it might make sense to move into safer investments to protect your progress. The most important thing is to start. Inflation doesn't wait, and the longer you delay, the more purchasing power you lose. Even small steps can make a big difference over time. Open that investment account. Start learning about index funds or real estate. Take advantage of tools like inflation-protected bonds. The sooner you act, the sooner your money can start working for you. To wrap things up, remember this: inflation is a challenge, but it's also an opportunity. It forces us to think about our money in a smarter way and to take steps that can improve our financial future. By understanding inflation and building a strategy to outpace it, you're not just protecting your wealth, you're creating the potential for growth and security. Thank you so much for watching. If you found this video helpful, don't forget to like it and subscribe for more tips on managing your money and building financial freedom. And hey, let me know in the comments, what's your favorite strategy to beat inflation? I'd love to hear your thoughts. Until next time, take care and stay financially savvy.